The future for financial services has to be bright in the near term with decent interest spreads. Analysts say the last decade has seen extensive digitization, which in many cases left customers sometimes alienated and missing the personal touch and engagement with the relationship manager. What artificial intelligence is now doing to make the difference is to restore the old personalized and customized relationship, giving customer experiences that will rebuild lost trust, also in a way that is more cost efficient and which will also expand service and product possibilities. Hello, this is Bode Oshosami on Global Business Insights, where we bring ideas and discussions on the business headlines. In this episode, we look at the future of banking and the emergence of a different world order as trade tariffs lead to negotiations between the two largest economies in the world. According to the Accenture latest study on banking in 2030, banks are increasingly able to deliver inclusive, personalized, and proactive services for individuals and businesses across the globe. Non-traditional players will continue to reshape the financial landscape, compelling more innovation from the traditional banks. Scale will continue to be an advantage as the largest institutions leverage unmatched efficiencies, technological innovation, and global reach to outpace competition and reshape the financial landscape. Also, the trend is in using artificial intelligence fully integrated into all aspects of service delivery and the backroom to deliver hyper-personalized banking experiences, with customers being able to design their own financial portfolio with tailored products, dynamic pricing, and customized advice. The greatest contribution of AI will, however, be to drive revenue and growth. Toluleke Adenmosun, senior partner at Verraki Partners, a leading African business solutions company, says the utility of AI for advisory and decision making is as relevant in banking as any sector. The foundation for AI is data and establishing trends from data to interpret and predict, adding that the relevance of AI for Nigerian banks will be determined also by quality of the data and application to decision making. In summary, the overall consensus is that banking will not just continue to thrive as interest rates remain most likely higher for longer. Services will aim to restore the personal touch of the past with the new automation architecture using artificial intelligence. Toluleke comments on the outlook and trends focusing on financial services in Nigeria.
There's no doubt that 2024 was a landmark year in the Nigerian economy, and especially in the financial system. In the financial services system, we had the mandatory increase, the announcement of the increase in the minimum capitalization requirements of licensed banks. But perhaps more fundamentally, there was a very marked change in the industry landscape and the emergence of what I would call the payment bank, the transaction fulfillment bank, which in some instances were actually not banks at all, but transaction fulfillment organizations that provided the point of execution services for payment and settlement. So we have the POS operators, we have the online payment companies, we have the instant settlement payment business. Those, I think, were the winners in 2024, as we saw increasingly a shift to card and electronic money settlement, a shift away from the check rail. And while we still remain a cash dominant economy, increasingly we are seeing a lot more transactions being completed on the electronic digital payment rails. So I think the NIF report in 2024, as well as CBN analysis, I don't actually have the numbers now, reported a significant increase in electronic settlement across all the digital payment channels. Now, you asked about winners as well as losers. I would, I don't think really it's a question of losers as much as missed opportunity. And the reason why I say that is that one of my favorite quotes is from the founder of Virgin Atlantic, Richard Branson, that says that opportunity is like the London bus. You missed one, another one comes around in another 5 minutes. All that is important is that you need to know where you're going and you need to be at the right stop. There will be another opportunity around the corner. So, what might have been the areas of opportunity missed for financial services system? I would say, in my opinion, it has to be in business banking. It has to be in the absence of offering and proposition to address the value chain of business banking in the Nigerian economy. There was a recent article in the economics that said that one of the problems with Africa, and I will say very relevant to Nigeria, is that we have too many businesses, but too little business. The scale and the size of our businesses make it challenging for the economy to grow and achieve the increase in productivity that is necessary to generate and build wealth that will make us more prosperous as an economy. Now, is there a role for the financial system? And is there a play for the financial system in increasing the offerings to support businesses to grow and achieve scale by addressing the entire value chain, cash to order, inventory management that is necessary to drive the growth of the business sector, be it the large corporates, be it SMEs, the individual businesses. I would say that perhaps that is the opportunity for financial services, and that is where the bank that gets that right will be the winner in 2025 and going forward.
As a more multipolar world emerges, the new United States has less ambition to set the rules and norms or act as world police. Trump, if we take him literally, understands the need to restore what he has called a golden age, as he sees the past role of the United States in, say, Ukraine or NATO coming at an economic cost, which is somewhat debatable given the fact that the US economy is outperforming most other allies like Europe. But this is not about the Eurozone. Trump is perhaps right in saying that the globalization in the last decade favored the rise of China in a way no one could have anticipated. Trump now wants to renegotiate the US position and its obligations in a fundamentally different way from what we have seen since Bretton Woods after the Second World War, and possibly dismantle the old order that the US invented and birth a new world order in which China and the BRICS alliance cannot be allowed to lead. The first salvo of tariff hikes by Trump could be more to provoke the kickoff of the reset that he wants to see, and is perhaps less about just deficits or fentanyl, nor is it about Canada, Mexico, or Europe. It is about the rise of China and the BRICS alliance. Still on tariffs, most analysts already anticipated a material but gradual stepping up of US import tariffs on China to an average effective tariff rate of 45% by the second quarter of 2026. While talks between Trump and Xi may smoothen to some extent the risk of a further escalation. For now, Trump stated earlier this week that he sees the 10% tariffs as a first salvo, with tariffs on China potentially moving much higher if no agreement is reached. All this comes with a lot of collateral damage as US companies exposed to China increasingly begin to feel the heat. China has started an antitrust probe into internet search engine giant Google. Beijing also added 2 US companies to its unreliable entity list: Calvin Klein owner PVH and biotechnology company Illumina. Australia has joined the US Navy and Italian government in banning Beijing's DeepSeek from all government devices and systems over what it says is the security risk the Chinese artificial intelligence startup poses. S&P 500 and the Nasdaq closed up yesterday, looking beyond Trump tariffs. After the bell, Alphabet shares were down more than 6%. That was in after-hours trading as revenue missed, though earnings beat expectations, while the cloud business growth slowed down. Alphabet reported Q4 earnings of $2.15 a share on revenue of $96.47 billion, below expectations of $96.68 billion. Also, though the Google Cloud business in Q4 posted a 30% increase to almost $12 billion, this was under the 35% growth in Q3 and also under the $12.2 billion analysts forecasted. YouTube advertising revenue, however, came in at $10.47 billion, beating estimates of $10.23 billion. The semiconductor company AMD reported Q4 earnings per share of $1.09, beating estimates on revenue at $7.7 billion, also above analysts' expectations of $7.5 billion. AMD shares initially rose as much as 3% in after-hours trading. That was just after the release. Pepsico beat Wall Street estimates for Q4 profit but missed on revenue. Revenue at $27.78 billion was slightly below the expectations of $27.89 billion and was impacted by low demand in the North American market after incidents involving product recalls in 2024. Shares of PayPal sank as adjusted earnings came in at $1.21 billion below the $1.44 billion expected, though it reported $8.37 billion in revenue for the fourth quarter, up 4% from last year and better than expected. PayPal 2025 projections also showed adjusted earnings per share short of expectations. Japan's Nissan called off merger talks with rival Honda, abandoning a tie-up that would have created the world's number 3 automaker. Asia share markets were mixed, with some relief that China was somewhat restrained in its retaliation against US tariffs. Markets are puzzled by Donald Trump's sudden suggestion that the United States take over the Gaza Strip. There has been no obvious reaction in oil prices. The American Petroleum Institute, API, however, estimated that U.S. crude oil inventories rose by 5.025 million barrels for the week ending January 24th, much more than expected, weighing on prices. Brent crude in early trade slightly down at over $76 per barrel. Well, that's it on this episode of Global Business Insight. You can watch us on Business Day TV YouTube channel Monday to Friday at 11 a.m. West Africa time. Thanks for watching. This is Bode Oshosami. Bye-bye.